Good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. We have had a pretty volatile few weeks here, a lot of volatility yesterday. So let's take a look at where markets currently stand this morning and what our outlook is going forward. Before I do, just what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off like we normally do with a major market update. And I want to spend a couple of minutes on this because I do think that major markets are at a very pivotal level. I want to make sure everyone understands how to look at these levels to give you a better understanding as to how to have a better view as far as over the next few trading days where markets are going to be headed. We will take a look at some of the indicators where how fixed income and commodities have reacted to the current move here in the markets. Not a lot of reaction that last week, but starting to see some reaction this week. So let's see where we want to pay attention to. I do want to give an update here on the FANG stocks that we talked about here on Friday. We've had some changes to our views as a result of the levels that we talked about here on Friday. So I want to update everyone here on that. We'll take a look at some of the economic and specifically the employment data, as well as some shipping data to give us a better understanding as to what ideas might play out here over the next few trading sessions or next few trading weeks. And then at the end, if we have a few minutes, I will try to answer any questions here in the markets. But the primary question that I want to help answer is really the questions that we've been getting over the past few days as to whether markets are starting to see a bit of a bottoming formation here. If you look at some of the major markets, you're starting to see some of the signs of potentially a market bottom. But the question is really, is this kind of a one-day fluke, or is this a continuation of that move lower? So just as we normally do, if you please bring up your chat window. If you think that markets are going to be lower 1 month from today, please type L. If you think markets will be higher from 1 month today, please type H, just to get a sense for the audience here in the room. So there certainly seems to be a lot more. I would say on Friday, there were a lot more L's. Today, we seem to have a lot more H's. So let's see. So let's take a look at what charts to pay attention to. What I will be sharing with you here today are my technical charts, the research that I'm paying attention to in terms of economic research, and lastly, the ideas that I have derived from these charts. So first of all, we're going to start off with the QQQ, or the NASDAQ 100 index. We've been talking about this 270 level for quite some time. That is the level that the index reached on the initial sell-off. It has traded near that support level multiple times, each time bouncing off, not managing to make a higher high. And just on Friday, we managed to break below that level. And yesterday opened up significantly lower, but actually ended up at the end of the day trading up fairly strongly. We are opening up just shy of that 270 level here this morning. So this is really important here as far as what we see in terms of price action. Do we see the markets open up to that 270 level and then immediately bounce lower? If that is the case, that certainly puts us in a much more neutral tone between these 250, 270 level. Yesterday, we managed to tag that 260 level that I referred to last Friday, which is the predominant, the average price that was traded in between these levels. So the 260 level was tagged here yesterday. Let's see if markets can resume back above that 270 level. I think today's price action will be telling. I would say that over the past few weeks, price action predominantly has been fairly weak, meaning what we saw here is that markets would on the open up higher, but throughout the day actually ended up trading lower. We predominantly saw that. Over the past few trading days, it's been the other way around, where markets were open lower, and by the end of the day, they would close higher. So we're starting to see a reversal here of price action, but again, one day does not make a trend. We are trading below that 270 level. That is an important level to pay attention to. As long as we're below 270, we're much more neutral on the NASDAQ 100 index. Yesterday was pretty interesting because the technology sector was the only sector that outperformed the broader markets. All other 10 sectors underperformed the markets by a significant amount. Financials took a huge hit on the recent report on roughly $2 trillion flowing through financial system in terms of money laundering. Industrials, materials took a big hit yesterday, and energy took a huge hit yesterday. So these are all sectors that were fairly strong and providing a bit of defense, all of a sudden reversing all of those gains here just in one day alone. So the question is whether this is going to continue or we're going to see back some more of that defensive play here over the next couple of trading days as the technology indices continue to kind of trade sideways or below this 270 level, that slightly bearish tone while we're fairly neutral. When we look at the S&P 500, the S&P 500 managed to get back down to the 323 level that we were referring to. It tagged that level yesterday, put in a pretty bullish, I would say, price action yesterday where we opened up low, traded all the way lower, but the markets closed back to its session highs. That, generally speaking, is a fairly bullish price action that we see. So the question is whether this 323 level will hold and we'll start to see a resumption of that bullish trend, or if we see a break below that 323, which would put us all the way back down to the 310 levels here if we do get that break below 323. So S&P sitting at some precarious support levels. The NASDAQ 100 index just shy of a major resistance level. So a lot of neutral views here, a lot of jockeying here over the next few trading days. So pay attention to the intraday price action. That'll give you some clues as to who's winning, buyers or sellers. Yesterday, clearly buyers were in control after starting the day at a fairly weak place. Buyers stepped in later in the day, came in fairly strong and brought the markets back to those levels. So pay attention to how they react here for the rest of the week. Now, when we look at emerging markets, this is one of the brighter spots here in the major indices. Emerging markets not falling with the major indices over the past few trading weeks, and has actually managed to hold that 43 support level fairly strongly. This is one of the sectors that we are paying attention to for further gains here to the upside as EEM remains resilient. And on the flip side, we see small caps start to weak even further. So this rotation that we started to see here over the past few weeks as these small caps played a little bit of defense on the sell-off, that is starting to come to an end. We're seeing that both on the small caps as well as the equal weight indices breaking below some major support levels while they were holding those levels, being defensive as the sell-off here. As equity markets kind of start to find its footing a little, we're starting to see these lag behind again. So this is all relevant for the direction or the outlook of the market, because this is what we saw prior to the sell-off was outperformance from just a few sectors, like in this particular case, like yesterday, just technology, while everything else started to fall behind. And you see these at near market tops. You see these near when markets are unhealthy. So we're seeing more signs of this. So we could see some more upside, but further unhealthy markets going forward. When we look at the VIX 3M, it is still kind of just stuck in between this 1 and 1.25 level. So down here is fearful, up here is complacent. We're kind of right here in the middle ground here. So not a whole lot that this is telling us. This is much more neutral, but generally speaking, when we have a neutral volatility curve like this, this is generally speaking slightly bullish here for the broader markets, or markets tend to drift higher when they are at these levels. So this providing a little bit of support. Also, if we look at the put-call ratio, the 20-day put-call ratio is continuing to improve over the past 3 weeks, meaning we're continuing to see a more balanced put and calls being traded, as opposed to over the past few months prior to the sell-off, we saw this extreme call buying versus lack of put buying. That has balanced itself out a little, and as you can see, the 20-day put-call ratio reversing back to 0.6, which is still fairly complacent from a historical perspective, but certainly much better compared to the past few weeks. The 20-week put-call ratio also starting to improve. The 20-week put-call ratio, obviously, we're taking a little bit more time to recover, but certainly starting to see some reversals here back into more of a normal territory. Still elevated from a call buying perspective, but certainly much more normal compared to the last few weeks. Now, we certainly want to see this continue, in my opinion, because this becomes more of a contrarian indicator for a bullish view. The higher the put-call ratio gets, the more bullish the market becomes. It's a contrarian indicator. If we look at volatility indices, VXN still kind of can't get back above 40, which is generally speaking a good thing because we generally don't want to see huge spikes in volatility. That generally is difficult to trade for everyone, but volatility sitting below that 40 level and sitting right now currently about that 36 level, which is significantly higher than January levels. But when you have more stability with these elevated implied volatilities, that is your ideal condition for selling premium, selling cover calls, credit spreads, iron condors, these types of strategies. These are the ideal conditions for doing so, especially when markets are fairly neutral. Might not last very long, might only give you a week or two of this type of condition. So these are the times to potentially take advantage of this elevated implied volatility while markets are neutral. If we look at the dollar index, this is really where we continue to see just a decline in the dollar that has started to stop. We have almost a bit of an inverted head and shoulders here. It hasn't broken above that neckline yet, which would target the $96 level, but this is one that I would pay attention to. And this has ramifications for some of the commodities, specifically gold. We are seeing this topping formation here in gold. We talked about this 180 support level. We talked about this triangle forming over the past few weeks. And the question is, which way was it going to break? So far, intraday yesterday, we got the break to the downside. Buyers did step in pretty heavily towards the end of the day, bringing the index, bringing GLD almost back to that 180 level. Not quite there yet, but certainly starting to show some cracks here to the downside. Gold would really have to get back above 184 for me to consider this, back into more of a neutral tone, slightly bullish tone. But until then, this certainly has a much more bearish tone here to gold, especially as that support level breaks. We'll take it. We'll see where markets open up here this morning. Pre-market looks like it's about to open up a little higher, just shy of that 180 level, but we'll pay attention to that as we get closer. Now, the fixed income markets were surprisingly quiet last week or the past few weeks while the markets were seeing a lot more volatility on the equity side. But we started to see a little bit of movement here from high yield yesterday. High yield down about almost 1%, which is a fairly significant move for a fixed income market. So high yield holding relatively strong, breaking lower here yesterday, testing that 200-day moving average. If we break below that 200-day moving average, this might be a signal from the fixed income markets giving us some early warning signs that, these high yield companies or high yield investment grade fixed income bonds are becoming less and less attractive. We are starting to see a little bit more inflow here into treasuries. So we're starting to see this rotation out of high yield into safer assets. So this could be a bit more of a flight to safety here as fixed income markets are starting to get a little jittery here. Now, one day does not make a trend, so we will keep tabs on this, but certainly we're starting to see some movement in the fixed income markets that were very quiet over the past few weeks as equity markets were sort of panicking. So looking at the FANG names, if we look at Apple, last week we talked about 110 being a major line in the sand. We broke below that level on Friday, but yesterday buyers stepped in with a fair amount of confidence and brought this stock back above that 110 level. One day break certainly is not enough to consider a broken support level, especially if buyers step in very quickly and bring it back above that level. But the fact that we managed to get all the way down to that 103 level is certainly concerning. I would need to see Apple back above 118 for this to be bullish. Right now, it's very neutral, but certainly with a more of a bearish tone here. Apple looking fairly weak, just hanging on to that 110 level by a thread. This is one that we're going to pay attention to here over the next couple of trading sessions, but specifically today's price action, I think will be telling as to the outlook here for Apple going forward. If we look at Amazon, on Friday, we talked about the $2,900 level as support here for Amazon. It did get down to that $2,900 level. So right now, Amazon very much in a very neutral tone between $2,900 and $3,100. It's opening up just a little stronger here above 3,000. So if you think about this, Amazon looking fairly strong compared to some of the other FANG names. Arguably, the retailers, Amazon and Apple, which are hardware and retail, certainly showing a little bit more strength here over the past couple of days compared to names like Facebook and Google, which are predominantly advertisement. There's no particular product that they have other than a platform to serve up ads. We're seeing a little bit more weakness from Facebook. Facebook breaking below that major 250 support level that we were talking about. It is still holding below that 250 level here pre-market, so not seeing the same type of strength as some of the other names pre-market. So this is one that we still see potentially further downside here for names like Facebook. Same thing here for Google. It's just that Google didn't take off as strongly, so Google's back to the 200-day moving average. It just tagged the 200-day moving average yesterday, also opening up a little lower here. So Google and Facebook on the advertisement space looking like the weakest out of the FANG names. And lastly, you have Netflix, actually the strongest out of the FANG names. Netflix holding that support level over the past few weeks, bouncing off fairly strongly off that level yesterday and opening up higher here today. So we are, as we start to see COVID-19 cases rise again in the US, we've had a pretty significant trend of rising cases for over a week now here in the US. We're back to 52,000 cases, which is something that we haven't seen for quite a few weeks. And a fairly significant spike too. We're seeing this in Europe. We're seeing pockets of this globally. So this is some of the concerns, and perhaps some lockdown stocks reigniting some momentum as a result of it. We saw a lot of these lockdown stocks see some significant downside moves over the past few weeks. We're starting to see a little bit of that come back to life as COVID-19 cases start to reemerge again. And we have some ideas along these lines. Tesla, battery day today, a lot of investors paying attention to that, but Tesla still in the process of completing this topping formation. This is what we talked about here on Friday. It has not exceeded that 450 level here. It has stayed below that 450 level, trading at that 431 level. So at this moment, we still expect Tesla to remain fairly weak here below that 450 level. Can Tesla battery day be the catalyst that pushes it back above 450? Certainly can. If we look at both momentum and money flow remaining fairly strong, so we could see a potential breakout here on Tesla into that 500 level. So overall, we have a market that is at a fairly pivotal moment. We have major indices that are either just at major support levels or just at major resistance levels between the S&P and NASDAQ. We have seen quite a bit of divergence here between the broader markets measured by the S&P and the NASDAQ 100 index. So the question really becomes, where do we really pay attention to? What sections do we pay attention to? And if we look at some of the FANG names, we see a bit of a mixed picture here on some of the names as well. And that is really the outlook that we see. It's a very mixed picture. And largely that has been the case for the past few weeks, largely, but becoming a little bit more mixed. Fixed income also weighing in some views here, because we're starting to see some outflows from high yield into treasuries. So a lot of movement here in the market. So really important to pay attention to what we see across these markets over the next few weeks, next few days, but also in the next few weeks. So when we look at the employment data, the headline numbers have been fairly strong, and markets have been reacting fairly strongly to them. The headline numbers, about 8% unemployment. But the real number that I think we need to pay attention to is really the underemployment and underutilization. So someone who wants their full-time job back but cannot find full-time work, or is working part-time, or used to be a mechanic but is now working at Starbucks, these types of roles. And we're seeing a significant percentage of the population being underemployed or underutilized in their roles, despite the unemployment number remaining, or the headline unemployment number looking fairly strong. And if we look at job recruitment is also fairly low compared to where we were at the beginning of the year. So when we're supposed to see the strongest in terms of job growth, while we initially saw that in the couple of months following COVID, but that really has stalled here over the past few months. And this is concerning to us, and some of the ideas that we have today follow this trend that we're seeing, which is not this significant growth that we've seen in employment, as the employment numbers may have may be showing. But if we look under the hood, there seems to be a lot of problems. So I want to show you some of the ideas that we have along these lines. The other one that we wanted to pay attention to is shipping data. So we know FedEx and UPS have been doing really well as a logistics company, but if you think about the global economy, it is beyond just FedEx and UPS shipping our Amazon packages because we're all sitting at home. If we look at overall freight indices, whether it's air cargo, whether it's trucking, we're seeing this continuing to rise as a result of COVID-19, as there is fewer passenger airplanes for air cargo to be on. So air cargo pricing have gone through the roof. Trucking also same thing, as increased demand for Amazon packages. There needs to be movement of these goods to different places. So railroads, trucking, we've seen a significant uptick in all of these indices. So if we look at the shipping indices, they are back near pre-COVID levels already. If we look at pricing for trucking, they are back towards 2018 peaks, levels that we have exceeded the pre-COVID-19 levels here. So these are some of the segments of the markets that have seen increased demand and have seen increased pricing as a result of that. So we want to take a look at what stocks may be able to benefit from this increase in terms of freight and shipping. So the first one I wanted to take a look at is CHRW, CH Robinson Worldwide. This is a logistics company to provide companies that need to ship their goods with shipping companies. They sit at the intersection of freight as well as technology. They are a middleman, if you will, and they've recently released some new technology that has made booking cargo space and freight space significantly easier and more frictionless. So this is one of the stocks that I like because not only do I like the fundamentals, but the technical price action looks fairly strong here. We had a recent breakout above that $100 level, came back to retest that as support, and this is the opportunity that I see for a potential long position. I would potentially look at selling some put credit spreads here at that $100 level for that level to hold. And if we do get a breakdown below that $100 level, you'd be able to cut your losses fairly quickly. You wouldn't have to take on the full max loss of the credit spread or even a debit spread if you chose to buy a debit spread. You would be able to risk a significantly smaller amount than the max risk of a credit spread that you sold here on a name like this because you're sitting just at support. A small break of the support would confirm that this trade is no longer valid, and you would get out at a fairly significantly smaller loss than the max loss of that credit spread. So I particularly like CHRW as a potential opportunity in the markets right now. Another one that is seeing a bit of weakness with the consumer staples, but Costco. Costco's seen some significant weakness here over the past few weeks, but it has held that 330 breakout level from early August. Did trade significantly higher from that level all the way through 360, came back to retest this as support. And I think that you have more of a neutral tone here for Costco, but I think 330 will hold, especially as we see that card spend at warehouse spending like Costco and BJ's remain fairly elevated compared to spend levels elsewhere, especially outdoor dining, especially entertainment, travel. We continue to see groceries and especially warehouse stores like Costco remain fairly elevated. So I think 330 is a level that's likely to hold. Similar type play to CHR Robinson, where if you get a break below 325 or so, you'd be able to cut your losses and risk significantly less than the max risk of a put credit spread that you would sell at a level here around that 330 level. ADP, this is where the vast majority of US payrolls are processed by ADP. So benefits, payroll, when you have 30 million unemployed, this is one of the stocks that is going to suffer as a result of it. You've had a stock that has severely underperformed the market here since the coronavirus recovery, and we're trading just above that 130 support level that has held for quite some time. And the question is whether or not we're going to see a break below that level here. It hasn't broken just yet, but this is one that I'm paying attention to. If we see that break below 130, this is one that I would be looking at potentially buying puts on, because you do see a fair significant downside here into the 105 range here to the downside. There's not a lot of trading volume here. You don't have a lot of buyers and the moment, in my opinion, down here. So I do think that if you break below 130, you're likely going to see some significant moves to the downside. So ADP, especially with employment with the headline numbers, with the real numbers underneath looking fairly different, this is one of the stocks that I think is under pressure and is likely to break below that major support level. Another one I want to take a look at is Qualcomm. Semiconductors have remained fairly resilient, as we see. Online electronics is one of the few categories that continues to see almost a double in terms of growth since the start of the coronavirus, as we all figure out ways to work from home, as kids figure out how to learn virtually, as schools continue to distribute their education online. Online electronics and communications is certainly one of the areas of the market that is going to continue to excel. We're starting to have the 5G upgrade cycle become a play here and later in the year. Qualcomm so far has held that major 110 level here. So similar type play here, where we're expecting more of a neutral view, potential longer term bullish view here going into the end of the year. But for now, holding that 110 level, same thing, we're trading just shy of that support level, or just shy of breaking that support level. So if you do see a break, you can cut your losses fairly quickly and risk less than the max risk of your trade. So Qualcomm, I think at the intersection of consumer electronics and the 5G space, potentially one of these stocks that will hold up better than other technology stocks. So with that, that covers what I wanted to share with you. Looks like pre-market, we're just hovering around that 270 level on the Qs. It opens up, a few seconds ago it was above 270, now it's below 270 level. So pay attention to this level, pay attention to the intraday price action to the markets. Do we open at 270 and immediately start to sell off, or do we open at 270 and buyers continue to step in and bring this back above 270 level? That's going to be very telling as far as who is control of this market and what is the price action likely going to look for the end of the week. So with that, that covers what I wanted to share with you. I hope that this was useful in helping you, give you a better understanding of the outlook here on the markets. As many of you, as the polls show, things are very mixed. Things are, there's a lot of different outlooks out there. So right now we're at a very pivotal moment. Pay attention, because that is what's likely going to drive some of the outperformance here over the next few weeks. Thank you so much. I hope you guys have a great trading day, and I'll see you guys here on Thursday for our options education session. Thank you so much and have a great trading day.